Let's be honest for a second, guys. A lot of people are talking about the XRPF, but not many people really know what's going on. You've seen the tweets and news stories, but what if I told you that the real countdown to XRPTF has already begun? Most people didn't even notice. While people on the internet fight about rumors, something much bigger is going on in the background. The stage is being set for one of the biggest waves of liquidity that XRP has ever seen, and time is running out. Hello and welcome back to Millionaire Formula. Today I'm going to show you the real XRPF schedule that no one, I repeat, no one is talking about. Not the analysts, the reporters, or people who have a lot of power. Once you know this schedule, you'll understand why the next few weeks could be very important for anyone who holds a lot of XRP. A lot of people think this is just another ETF rumor, a new token for the same story. But things are set up very differently this time. In the past few weeks, Canary Capital, Bitwise, and Grayscale have all quietly filed their XRPFs at times that were not chosen at random. They have something in those files that most people don't know about. A 20-day rule that goes into effect automatically as soon as a change is sent in. That means the timer is not going to start. It's already going. On October 24th, Canary Capital filed. 20 days started with that one submission. Then, on October 31st, exactly 1 week later, Bitwise filed their change, which began a new case. These aren't just rumors. These are real documents that can be found in the SEC archive. Unless the SEC steps in, those ETFs will start trading as soon as the timer runs out. Let's talk about being inside the engagement window right now. There have been no news releases or hype. There's only a ticking clock that could let a lot of institutional investors see XRP. Now think about how the launch of Bitcoin's ETF went. Months before it was approved, it was in every news story. Analysts talked about it every day. Small buyers jumped in right away. But things are different when it comes to XRP. This release is meant to be quiet. These groups don't want any attention just yet. They want to be positioned, building up, before the news becomes widely known. That's how smart money works. They move early when stores aren't paying attention. They build up quietly while the noise goes in a different direction. And the time makes perfect sense if you've been paying close attention. Instead of being just another token on an exchange, XRP is the bridge asset that was made to be useful in the real world for global settlement and is backed by agreements across the financial system. You can read the XRP Millionaire Blueprint to find out how the top 1% of investors are getting ready for the next part of XRP, including their thoughts, their plans, and the way to becoming a millionaire. The link is in the note below that has been pinned. Okay, let's go ahead and move. Now, things get really interesting. Not many people were interested when Solana, Litecoin, and HBAR ETFs went live last month. Prices didn't change much. It was called a failure by everyone. But that was just a test. As a quiet way to check the system before the real rollout, there was no talk of short-term price changes. It was to make sure that the system for the ETF could handle digital assets other than Bitcoin and Ethereum, because XRP comes next. If you pay attention, you can see how they work together. Canary Capital's statement wasn't made up on the spot. Bitwise coming back a week later wasn't a coincidence. Grayscale is also quietly lining up its XRP trust growth. It's also not random. These moves are planned ahead of time. Activation times that overlap and land right in the middle of November. I keep saying this isn't something to wait for because of this. The time has come. They have been filed. The work to get ready for the cash has already begun behind closed doors. Let's talk about why that's important. When an ETF goes live, it doesn't just give small buyers a token. Regulatory investment channels make it possible for institutional money like pension funds, hedge funds, and asset managers to properly get in. That means they can buy XRP-backed ETF shares without going through an exchange, worrying about storage, or worrying about the law. At that point, billions can easily join the market. The benefit of XRP in this case is truly special. It is legal in the US, which is different from other digital goods. What this means is that ETF producers have fewer problems, less legal uncertainty, and shorter setup times. You can see why these ETF files are so important when you add in Ripple's global network of payment corridors. Let's picture it for a moment. Imagine that all of a sudden, a huge wave of institutional demand meets a small supply. Over half of all the XRP that is available is locked up or kept for a long time. The amount of usable float is not very big. There is what is called a supply squeeze when ETF funds start buying XRP to back their shares. Tokens are getting harder to find as demand goes through the roof. That's when prices start to move faster, not because of the hype, but because of how it works. To protect investors, ETFs need to hold real XRP. This means that there needs to be real buying pressure on the open market. This is what makes the timing of these applications so interesting, because it fits nicely with big events on a global scale. Rate drops, more money coming in, and the slow end of quantitative tightening. The Federal Reserve is becoming less strict. Markets are beginning to get more liquid again, and in the past, high liquidity assets are the first to be re-injected with new capital. There are already assets like XRP that are useful in the business world. When you put all of these things together, you can see that ETF filings have already happened, there is a limited quantity, and institutional demand is about to come in. We've never seen that set up in crypto before. Let's put this all together now. People were excited about Bitcoin's ETF months before it even came out. The news helped start the rise early, and by the time ETFs went live, the market had already priced it in. With XRP, however, the story is told backwards. The filings took place in silence. There is no fuss about the setup. That is, it's not anticipation when the market wakes up to it, it's spark. I call the point where ETF action meets macro liquidity ignition. And the countdown to that phase isn't just an idea, it's already happening. The timer started when those applications went through on October 24th and October 31st. The activation time for Canary Capital lasts until the middle of November. After only a few days, Bitwise is activated. In other words, XRP could get institutional access at the ETF level for the first time ever in the next few days. Everything changes when that door opens. The liquidity pools get deeper. It gets busier for open trading company desks. CME futures trades are going up, and institutions that have been waiting for compliance green lights now have a clear, controlled way to get started. That's when money starts to flow. First slowly, then quickly. When Wall Street moves, money doesn't just come in slowly. It comes in a rush. That's where we are now. Just before the storm, the XRP ETF applications from Canary Capital, Bitwise, and Grayscale quietly began their activation clocks in late October, as we already knew. The thing that most people don't know is that these countdowns work together. They meet up. That intersection is what will help you figure out what's going to happen. Each ETF offer is like a bomb. Canary Capital was the first one to go off on October 24th. That timer lasts for about 20 days, so by November 13th, the ETF can start up on its own unless the SEC issues a stop. Bitwise was the second spark that was lit on October 31st. Its 20-day period ends around November 19th. Grayscale's amendment fits right behind them and almost perfectly afterward. This means we're starting a series of activation windows instead of a single event. Layered liquidity ignition is what this process does. It sets off a staggered flow of capital access that builds momentum. It lets more than one wave of water come in instead of just one sharp spike. Early demand is met by the first ETF. The second one makes it worse. The third proves it. The movement is already well underway by the time the media catches up. This isn't a guess. This is the same trend that showed up during the ETF cycle for Bitcoin. It wasn't until mid-2023 that the first Bitcoin ETF filings were made public. The market didn't really respond. But as the due dates got closer, things picked up speed. Early on, institutional desks began to move. From open to close, the volume gently rose. Then, when the SEC gave the all-clear word, retail saw what had been building for weeks. Prices went through the roof, not because of sudden news, but because the money was moving before anyone else did. That same setup is being watched again, but this time with a different object and a smaller window. The quiet filings, the secret timers, and the positioning of institutions are all parts of an entry. Almost everything starts to line up with macro time at this point. The Federal Reserve will have its last chance to talk to the public before its December meeting around the middle of November, when the first ETF countdown reaches 0. That's important because the Fed is likely to change its policy tone from tightening to loosening. In the past, rate cuts, or even just the thought of them, have caused new money to flow into risky investments. This means that there will be more cash available, more interest in growth areas, and higher prices for digital assets when regulations are clear. When macro liquidity and ETF action come together, they make what I call a double ignition. Accessibility meets the availability of cash. Things start to move quickly after that. Let's make this easy now. Getting ETFs isn't the same as getting stocks from regular people. They don't bother with price. Instead, they build things. Every share that an ETF sells is backed by XRP. In other words, the fund needs to buy real XRP to hold until buyers start buying those ETF shares. The more money that comes into the ETF, the more XRP it has to buy. Because there is a limited supply of XRP, about half of it is locked up in escrow, and a big chunk of it is kept by long-term wallets. Each wave of institutional demand makes the supply even tighter. This is where the price goes up faster. Liquidity doesn't just go away, it moves around. When big investors buy ETFs, the available float goes down and the market as a whole moves up. The same thing happened with gold when the first gold ETF came out in 2004. In just 1 year, ETFs gave institutions access to hundreds of tons of new buyers, which drove prices sky high and started a bull cycle that will last for years. Many of those things are also true of XRP's setup, but it's faster and easier to see in real time. Also, the derivatives side is something that most experts don't talk about. As soon as ETFs start trading, the CME futures markets and institutional trading teams start to increase open interest to protect themselves and match the flows. That's already taking place. In the past few weeks, there has been a quiet rise in volume on XRP futures. This is a sign that big players are getting ready to get exposed. When they think things will change, they hedge. They don't guess. They get in place early. Let's talk about what this looks like in the market now. When liquidity is being ignited, the first move is usually very small. Slowly, prices will rise, lows will rise, and volume will grow without big price jumps. That's what establishment accumulation means. Then, when the first ETF activation happens and early money starts to come in, the momentum picks up. As prices rise sharply, shorts start to close, and stores start to notice. That's the second step, which is becoming aware. The third step is the confirmation move. As soon as multiple exchange-traded funds go live and money starts moving through them regularly, the news media, analysts, and regular people start to pay attention. Early positioning will have been done by then, and the liquidity engine will be fully up and running. There is no change in prices because of guesswork. They move because of how they're built. That's what's taking place. Now let's look at the bigger picture and talk about why this XRP ETF cycle is more important than others. XRP doesn't just want to be a way to save money. It's a bridge asset for transactions. In other words, the ETFs help more than just buyers. They help systems that already move real money around the world stay liquid. Once these ETFs set up a controlled path, banks can use XRP exposure as a tool for liquidity, not just a bet on the price. That's a big change. If a bank, money transfer service, or settlement network already uses RippleNet, they can now use exchange-traded funds instead of direct shares to balance their risk. That supports the price and keeps the traffic going. ETFs are more than just smart money. In a bigger world picture, they become instruments of liquidity. And this fits right in with what's going on around the world. The G20 has already pushed for crypto rules that apply to all countries. Cross-border settlement norms are being talked about at the IMF. Also, many central banks are working toward digital payment systems that can work with each other. Because of how it was designed, XRP is at the center of these talks because it settles quickly, has little friction, and connects different types of liquidity. When you add regulated ETFs to that environment, you have the building blocks for a network that is truly built for institutions. This is what most small buyers miss. These ETF applications didn't just show up out of the blue. They stand for getting ready. Companies don't file things they aren't going to use. The steps needed to file, revise, and activate an ETF take months of planning and work. People who keep money safe, do audits, make markets, provide liquidity, and talk to regulators. It's not a coincidence that several applications became public within days of each other. This is synchronization. It means that the equipment is ready, and money will come once the equipment is ready. If you look at XRP's last few big cycles, from 2017 to 2021, you'll notice a pattern that keeps showing up. Right before explosive expansions, there are always times of consolidation, disbelief, and low interest. Even though history doesn't always repeat itself, it does match. The mood we're seeing now, quiet, unsure, and distracted, is exactly what comes before big moves. That's what's so interesting about this ETF trend, because it's not just a business story, it's also a change in the way things are built. As soon as these ETFs start trading, XRP will change from a digital asset that most people trade to an institutional-grade instrument with regulated entry points. Everything changes because of that shift. Long-term value, cash, and how people see it. If you want to see how strong that is, think about what happened to Bitcoin after the ETF. Institutions that didn't care about it before started allocating. Pension funds made things more risky. It was first used by insurance companies to spread their risks. In just 1 year, Bitcoin went from being a risky niche product to a well-known part of many portfolios. The road for XRP could go in the same direction, but faster, since the technology has been ready for business use for years, and all the regulatory hurdles have already been cleared. This brings us to the present moment, the quiet before the engine starts. The windows are ticking, the files are open, and the alignment is moving. In the coming days and weeks, we'll start to see confirmations, listings for ETF shares on exchanges, custodial assignments, and changes in pre-launch trading. And that's when the energy shifts from paperwork to the flow of the market. That won't just be a price event, it will be a turning point for the whole community of XRP. When money comes in through ETFs, it doesn't just sit there. It makes the market more liquid, keeps prices stable, and brings in even more big players. That's how institutional processes stay strong over time. We're getting close to that phase now. This is where the understanding that separates casual viewers from those who can see the structure taking shape below the surface comes into play. The story will be different once the ETFs are live and liquidity starts cycling. No longer will XRP be talked about as a speculative digital currency. It will be talked about as a way for institutions to get cash. At that point, everything changes. Watch how volume, open interest, and institutional inflows change as these activation windows close and the first ETF goes live. The next part will be clear from those data points long before it makes the news. This is not advice about money. Now we're in the last phase, which not many people will notice until it's already happening. The time between when an ETF is activated and when trading is activated. It won't happen overnight. There is a development. A slow increase of pressure below the surface until the system moves from getting ready to moving. Something small starts to happen when the first ETF goes live. Feedback on flow. Early investors put money into the fund, which then buys XRP. Custodians then rebalance their stocks. When this happens over and over again across various ETFs, the underlying liquidity starts to get tighter. That means something easy. Each new flow of money makes a small change in the supply, and those changes start to add up. At first, you can't see the result. Prices might go up a little, volume might go up a little, and people's feelings are still unclear. But those changes on the surface hide changes in the structure. In the same way that the tide rises slowly before it can be seen from the shore, institutional liquidity rises before individual investors know what's going on. Then there is a quick shift. As a result of the new exposure, market makers start to change spreads, exchanges make changes to liquidity pools, and swaps markets increase open interest. This is where instability gets smaller before it gets bigger. Before the direction rise, there was calm. Now, think about what this means in real life. XRP has been trading in waves driven by retail investors for years. Rapid peaks, deep valleys, and strong feeling. It's not like that now that ETFs is in play. The way institutions deal is not based on emotion, but on allocation. They make plans 3 times a year and structurally. That steadiness changes how the asset acts in every way. It gets easier to find prices, easier to get cash, and easier to predict how volatile prices will be. This is what a stable market is built on, and it's happening right now. These things have been missing from digital goods for 10 years. Depth of structure. Up until now, the only way for institutions to take part was through derivatives or exchanges that weren't controlled. That's not the case with ETFs. They bring in risk that is regulated, clear, and auditable. That's the reason why this isn't just another hype wave. It's making XRP a real part of the world's banking system. That, along with Ripple's current banks, payment corridors, settlement networks, and integrations, makes something that has never been seen before. A controlled financial product backed by an asset that is used in real life and has a useful value. This makes a feedback loop where price and usefulness make each other stronger. The more people use it, the more institutions can see it. The more institutional contact there is, the more stable adoption is. That's the spark phase, the point at which value changes from speculation to structure. When that wave starts, it can't be stopped. It goes around the world. North American exchange-traded funds set the standard, which brought in big capital and proved the asset was safe. Investors from Europe follow ETPs, structured notes, and digital trusts, which increases their risk in all controlled markets. Asian liquidity desks and futures platforms, on the other hand, copy the flow through synthetic instruments, keeping up with the same speed. What begins as a legal breakthrough in the US quickly turns into a synchronized revaluation around the world. This is such an important moment because of this. Because XRP's liquidity is about to become fully linked across regions, institutions, and regulatory borders around the world for the first time. Think about what it will look like in 6 months. There are now fully operational ETFs, steady amounts of money, derivatives, markets that are growing, and on-chain volume slowly rising along with institutional demand. That's an environment that supports itself. It's what turns a product from a trade based on speculation into something that supports the economy. When that happens, the conversation will never be the same again. Analysts who used to think XRP was a dangerous token now call it a strategic liquidity asset. The news changes from rumor to allocation, and people who put their money in early aren't reacting. They're already known, and the story is catching up to them. That's how every big cycle starts, slowly, formally, and a long time before it seems clear. Finally, let's go back to the macro side one more time to finish the loop. The world's cash supply is growing again. The dollar index is getting flatter, inflation data is getting lower, and central banks are getting ready to change the direction of policy. In the past, this has always been good for digital assets, especially those that help people move money between countries and use their money more efficiently. In that area, XRP fits right in. As these ETFs go live and money starts to move through them, we're seeing the start of the next era of liquidity, where XRP does more than just trade in markets. It supports them. It becomes a part of the system that moves value around the world in a way that is controlled, scalable, and compatible. That's what makes this setup so strong. Structure, timing, and unity are what hold it together, not hype. 3 layers line up at the same time. Regulatory access through ETFs, growth in macro liquidity, and adoption at the corporate level. When those line up, they don't cause instability. They cause change. Cycles are set at times like this, not because of guesswork, but because of where things are placed. The files, the countdowns, and the activations are all signs that a system is moving from getting ready to running. The planning is done and the clock is ticking. In the world of finance, the clock never stops. As we move from the rest of November to December, keep an eye on more than just price. Pay attention to behavior, inflows, volume consistency, and changes to institutional products. Those are the first signs of what's going on below the surface. By the time the news calls it a new phase, the structure will already be in place. So that's where we are now, on the edge of ignition, where time, patience, and understanding all come together. For those who see it early, there's no need to guess. Finding order before everyone else does is what it's all about. Everything will be different when it does. If you want to not only understand this change, but also make the most of it, the XRP Millionaire Blueprint is the complete plan for getting ahead of the crowd before they get there. Just as clear as what the top 1% use to stay ahead of every big change. Put a link in the comment below.